Good afternoon, everybody, and good morning, good afternoon, or good evening to those listening online. As Ted said, my name is Simon Cook. I'm a partner at Sullivan, working mainly in the trade and commodity sectors, but also general emerging market finance. And I've probably spent the last 15 or so years specialising in the Middle East and Africa. So this is a subject quite dear to my heart. We've got a great panel here today. What we're going to be looking at is the trade finance gap. It's been talked about for many a year, and the most recent reports have put it somewhere between 80 billion and 120 billion a year, quite substantial. So we're going to be looking at some of the potential solutions to closing the trade finance gap. We're going to be looking at how we got here, what the causes of that gap are. And we're going to be looking at some technological issues to see whether those sort of tools can be used to help ease the problem. And then lastly, looking at some of the other players and what they can do, alternative financiers, governments, regulators, that sort of thing. Before kicking off, I'm just going to invite the panelists to introduce themselves. Perhaps, Shalina, I can start with you.
Sure, thanks. Hi everyone. My name is Shalina Govind. I am part of the Debt and Trade Solutions team at Rand Merchant Bank, also known as RMB. Rand Merchant Bank is the corporate and investment banking division of the First Rand Group. The First Rand Group, we are one of the largest financial institutions in Africa by market capitalization. We are present in South Africa as well as 11 other key African markets, as well as the UK, India and China, and we have a deal execution footprint across 35 countries, 35 African countries. It's very good to be part of the discussion. Thanks, Simon.
Natalie?
Thank you. I'm Natalie Sakalova, Head of Multinationals and Financial Institutions at Zenith Bank UK Limited. We are a subsidiary of Zenith Bank PLC, one of the largest financial services provider in West Africa. Zenith Bank UK's primary focus is on providing solutions to assist trade and investment flow to and from Africa, with predominant focus on the areas of the group's business and presence. As one of the key and primary business area is trade finance, this session is a particular pertinence to me, as we always strive and look for opportunity to improve by way of new products, innovation, and partnership. So thank you, Simon.
George Wilson, Investec Bank, and really starting and leading the charge for Investec Bank in trade finance in Africa. And yes, this is a subject very close to our heart.
Thanks, Simon. John Lentane. I head up Tiser's credit and political risk insurance broking team. We work globally, de-risking investment trade. We actually have a very big presence in the African markets, and we work with all of the African multilaterals to one degree or another, including in particular ATI, which is where I used to work as a chief underwriting officer and helped that institution grow significantly over recent years. So delighted to be here in person.
Exactly. Well, thanks very much, everybody. Just before we get into the session, just to explain how it's going to work, I will probably stop at some point during the middle and ask if there are any questions in the room, and then again at the end, so get your thinking caps on. In the meantime, you can also put your questions through online, and then George Mitchell will forward the ones to me that win the lottery and get put through. And we'll try and answer those as we go along. So, okay, getting into the session, the first area I think was really just to set the scene a little bit and look at some of the reasons why we are where we are in terms of the trade finance gap. Is there anything we could learn from past mistakes, that sort of thing? So, George, perhaps you could set the scene a little bit for us.
Yeah, so there's quite a lot of commentary around the trade gap. But I guess in order to solve it, there needs to be some kind of analysis of what are the causes of the trade gap. And that's pretty clear. There's been some very good research over the course of the last decade, I guess, where the Africa Development Bank in a 2014 paper and then followed up by the 2016 ICC trade survey, which had an excellent 100-page expose on trade finance in Africa. It wasn't that controversial, Simon. Drop the mic. Really lifted the lid on the trade finance gap in Africa, in emerging markets more generally, but specifically in Africa. And that is quite simply SMEs and MSMEs are unable to obtain trade credit from their banks. And that really goes to the root cause of the gap. That's what the gap means. It means that there are African merchants, African businesses, largely in that MSME segment, who simply cannot obtain trade credit in order to fund their trading activities from their credit providers, who are overwhelmingly their banks in Africa. The cause for that is actually pretty clear. There's been a lot of regulation recently, particularly since the financial crisis, but actually stemming from before that, which was aimed at protecting the globe from another meltdown of an American investment bank. And some very sensible regulation was put in place in order to protect the globe from that happening again. Unfortunately, that's really toxic, and the unintended consequences of that regulation is extremely toxic to African trade finance. And that really comes in two places. One is liquidity, dollar liquidity, which is extremely expensive and difficult to come by in Africa. And unfortunately, trade finance, cross-border trade finance, is denominated in dollars. So a lot of the regulation and a lot of the paucity of liquidity in US dollars is one of the causes of this gap. The tier 3 banks, who are overwhelmingly the actual providers of credit to real SMEs on the ground in Africa, simply don't have that much US dollar liquidity. And if they do, it's very expensive, and they don't necessarily want to use it, such a sparse commodity, on these kinds of activities. And then the other really important factor is these same tier 3 banks, or maybe even tier 2 and tier 1 banks in Africa, have a significant regulatory capital problem. They're subject to Basel, and they can use very sparse capital to fund trading activities of their SME clients, which is very risky, and they have to hold huge amounts of capital, and it's very, very unprofitable. Or they can use exactly that capital and invest it in local government bonds, zero risk, actually zero capital, and make 14%. So, they have shareholders, and that's what they choose very sensibly to spend it on. Unfortunately, it results in this trade gap.
Thanks, George. I mean, one of the other areas which is commonly talked about as causing problems is the general position on logistics and transportation, which makes it much more difficult for financiers to structure deals in a way which makes them financially viable. Would you agree with that, or do you think that's less of an issue now?
So, I mean, it's not one of the original causes, but it's certainly been exacerbated with COVID. The stress on supply chains, the stress on the logistics, and the fact that a lot of, even where they were able to obtain some kind of financing for their supply chains, the lockdowns coming from the pandemic meant that they were delayed at best, and financing out beyond 180 days, sometimes beyond a year, has just put this out of the reach of a lot of those lower tier banks in Africa. So it's made it a lot worse.
I think now that we sort of had that little bit of a scene setting, I'd like to look at what the challenges are in trying to close the trade finance gap and some of the potential solutions and potential new products and tools. So Shalina, if I could come to you first from the commercial bank side, what sort of perspective do you have on that?
Sure. Thanks, Simon. And I think that George has already highlighted quite a number of the significant challenges. So just following on from George, most institutions were forced to prioritize trade finance to just their key customers only. And therefore, obviously, isolated a key segment of trade finance customers that needed access to this liquidity. And as George mentioned, these customers were customers within your SME sector. Also, to add, these are SME customers operating in very vulnerable sectors. Our research team at RMB, in our latest Where to Invest in Africa publication, actually referred to these sectors as the triple threat sectors, which is transport, trade, and tourism. And these sectors were actually crucial in unpacking the pandemic and also indicating what economies should focus on going forward. So I think these challenges have actually heightened the need for financial institutions to carefully consider how our solutions play a part in fostering trade within these emerging economies, and also to assess and impact the trickle-down effect that our deals have, or the deals that we support in these markets. So solutions that enable financial support down the value chain, that is support not being provided just to your first-tier suppliers, but more focusing on suppliers deeper in the supply chain, certainly received a lot of focus from our perspective. In this regard, I think I'd perhaps maybe take the opportunity to just give a few examples. RMB partnered with a client in the agricultural sector to provide some funding solutions which assisted the client to underwrite a newly registered DFI. The DFI was formed to basically provide financial support to the local farming community. In addition to that avenue, we also provided funding support to the Grower Support Program, which actually monitors and supports or ensures that there is a successful crop. I think maybe the other aspect perhaps to mention in terms of solutions is the initiative with government in terms of partnering on public-private partnership programs. At RMB, we identified that there were certain sectors or entities that government supports to actually promote economic transformation. And these entities actually needed access to their to funding to support their procurement cycles and their offtake contracts. So we partnered with government to provide bespoke trade and working capital solutions to these entities, and in doing so, played a part in fulfilling this gap. Also, just very quickly, want to talk about the partnership with DFIs. We found this to be very beneficial. Particularly in where some DFIs have actually stepped in to provide support up to 90%, sometimes up to 100% for certain markets, certain sectors, and perhaps strategic imports that sovereigns have so classified during the pandemic. And this really enabled us to continue to remain relevant to our clients and also to support our clients perhaps in markets that we didn't have any presence. And last point in terms of solutions, I think it's worth mentioning the use of technology and the enhancement of our technology to enable our clients to continue transacting seamlessly with us. And I think going forward, it has just heightened the need for financial institutions to continue to focus on how we can deploy our technology to digital trade ecosystems that are able to track sustainable trade end to end. And hopefully this may bring about the ability to deliver trade finance at a lower cost at better returns. And in doing so, it allows us to access or provide access to the entire value chain. So yeah, I think those are just some of the solutions that we certainly focused on and we found to be quite beneficial in terms of addressing the gaps. Thanks, Simon.
Thanks, Shalina. Just to pick up on the sustainability point, obviously recently ESG has become much more prominent in the market, which I'm sure will throw up its own challenges. George, perhaps you could give us your view on where it fits in the market and what potential issues it raises that are new and how it may benefit in the long run.
Yeah, so I mean, to be clear, the solution to this problem is going to be from foreign direct investment, from DFIs, from international investors, and I've got kids, and I obviously embrace everything that's happening from a consciousness perspective around COP26, from an environmental point of view. The risk is that ESG for international investors and DFIs just turns into E, and and it precludes the social and the governance side of things. I mean, as far as I'm concerned, necessarily financing trade in Africa and closing the trade gap is ESG by definition. But there is a risk that the international investors are going to be able to salve their conscience by investing just in climate change and carbon neutrality and kind of forget about the pulling Africa out of poverty and starvation and developing the African economies, the major driver of which is going to be trade finance, and that needs to be addressed, and it needs to be consciously addressed, and we need conferences like this in order to heighten the social and governance side of investing in trade in Africa, at least on a par with the environmental point.
I think I'd have to agree with that. Natalia, we've heard from George and Shalina. Where do you see banks like Zenith's role in this? What can you see the bank doing to help close this gap?
I think, Simon, there are two things to look at it. What we can do today and what we should aim in the future. So for an international bank like ourselves, today we are financing local banks. We are evaluating and structuring, for example, receivable finance solutions so that we provide financing to the very SMEs that we're talking about, however the risk is taken on the buyer. And we do a lot of transactions in cooperations with other institutions. But what I think is important element that both George and Shalin mentioned is ESG and digitalization, which I think we just need to find a way to bring to light. And what I mean by this, I think we are lacking transparency and accountability when we're talking about trade finance. A lot of deals are private, et cetera, et cetera. So I strongly believe that digitalization will help in those two areas. It will allow us to unpack the ESG accountability, will allow to show how the value is created along the chain, and that will help the whole industry. For example, I'm aware there are platforms which aim not only to equip the large corporate or banks with the digital tools, but also to allow that very SMEs that produce the goods to receive money, and they show how the payables go through the value chain. Some of this already roll out in Southeast Asia. So the question is when we will see something like this in Africa. And I think that would be a great help.
Well, certainly, I think the receivables finance side is something that's being pushed by a number of institutions and DFIs. So it's still a work in progress. I think it has to bring together all sorts of things, not just the product and the expertise. It also requires the technological side. But it is certainly an ideal product for helping with the SME market. I think if they can get it right, then I'm sure it will provide a lot of help. George, you were talking earlier about the funding structures and the fact that most of the SME market gets funded from the lower tier banks. Do you see a way in which perhaps partnering with the higher level banks, the international banks, the DFIs, can help to filter that money and get it to the right place?
Well, yeah, I mean that's really that's the trick, right? So the point around the G bit is and the governance is this proof of trade. There's plenty of appetite for international investors, multilaterals, DFIs, etc., to pump their money directly at this. The problem is that they require proof that those dollars are being used in order to finance women-owned entrepreneurs in Ghana, right? And the difficulty is that the actual bankers to those women in Ghana are the tier 3 banks in Ghana, and they don't collect all of that information. So even if you aggregate up all of these tiny, very short-lived assets up to the tier 1 banks and the regional banks, they simply don't have the information to prove that it's being used for a specific purpose. If you overlay that with the kind of logic gate that now necessarily comes into ESG, is necessarily all trade finance in Africa, is that ESG, or is it only ESG if it doesn't actually harm the environment, or does it actually have to be positive for the environment as well as and renewable in some way, as well as being trade finance and closing the gap? And all of that information, we have a huge information problem. Either the international community trusts the governance of regulated banks across the continent, which may be a step too far for them, or we have an information problem. The answer to that is almost certainly digital, but it has to be digital at the ground level. It's too late once it's all aggregated back in $10 and $50 million chunks. The DFIs typically and the investors want to actually put the money in. There is one of two ways. So either there's a level of trust in the governance that exists through the regulated network, or we need some kind of digital solution right at the ground roots. And as Natalia says, that may be successful in Southeast Asia, but in Africa, these kind of activities are incredibly paper-based.
Indeed, they are. We were talking earlier about liquidity, and I don't want to go into too much detail because it's going to be part of the next session. But one of the products that is talked about a lot in terms of providing extra liquidity are the structured LCs. Do you, say, without going into the next session, is it something that you see that could be significant in terms of easing liquidity, or is it a relatively minor significance?
So it's an absolutely essential part of the puzzle. I mean, candidly, the countries themselves don't generate enough dollar-denominated exports in order to fund their trade portfolios as it is today. The banks and the countries and the central banks across Africa have no other natural source of dollars So the kind of liquidity, particularly short-term dollar liquidity, which matches the trade portfolios exactly that we're talking about, can only be generated through structured LCs.
I think, if I may, Simon, right? I was just sort of listening to George and in my own mind agreed and disagreed with a number of points, if I may, right? I think, George, I totally agree with your analysis that the infrastructure of a small banks who ultimately finance SMEs is probably the most efficient way to provide funds on the ground. But you're absolutely right. I mean, we as international banks wouldn't touch those banks for all sorts of reasons. I can't dwell into details, but there is no need. Hope you'll understand it. And yeah, we provide financing to the top tier banks where structured LCs can be one of the solutions. But I think not the only one. So for example, in Nigeria, we are financing development bank in a transaction where there is a guarantee from central bank. And I think this is sort of almost perfect example how it should be done. Not necessarily central bank, but disseminating funds from international banks to someone reliable who then finance the SMEs.
And obviously, your market is going to be Nigeria in the main, but do you see that as something that could be done elsewhere on the continent, or is Nigeria in that sense a bit of a special case?
Well, I think what we need is to roll the best practice across the continent. I agree not everyone will do the same structure. They may not have a strong development banks on the ground, or their own central bank will not support them. However, there are insurance, there are DFIs. So I think if we will come up with a structure that allows international banks to finance and small banks to receive those funds, perhaps as a wrap with DFI or insurance or someone credible, that would help to achieve the goal we're talking about.
Thank you. You mentioned insurance there, and actually I think it's probably the right time to bring John in, and you can't really have a conversation on this topic without talking about the role that insurance can play. What's your take on it, John? How do you see insurance being used potentially in new ways to help?
I mean, it is a very important tool in backing liquidity in Africa. It's hard to know the actual numbers, but ATI's portfolio these days is about 6.5 billion. They're the fourth largest African development finance institution, roughly, off the back of that. The bigger ones would be the banks. I think that at any given time, something like 100 billion of insurance is outstanding on the African continent. And obviously that comes from a number of institutions, multilaterals like ATI, MEGA, ISEC, but also ECAs and, of course, private insurers. But they're all terribly discreet, and nobody ever tells you exactly what they're doing. So that's why you need people like us, I guess, to access them. But for the big ticket transactions, insurance is always there, right? So we've just closed, some of you might have read about the $1 billion financing that closed in Angola last month. And again, we helped with that, and it was all syndicated to insurance. It's the biggest ever use of World Bank guarantee and blended finance. Lovely stuff. But, it took a long time to get there, and it's not easy. And Angolan capacity is incredibly constrained. And the same is true with Kenya, and the same is true with Ghana and Nigeria, and the list goes on. And insurers have the same kind of problems that banks have, So most of them will have country limits. Country limits are basically based around rating. And I always like to think of this in a geographical context, that Benin these days is actually, and well done to the Minister of Finance in Benin, who some of us have met, is a great guy. He's done an amazing job getting Benin 3 ratings in the last couple of years. But Benin is now rated actually higher than Nigeria, I think, certainly in the single B region. But most insurers, therefore, will allocate the same amount of capacity to Benin as they will Nigeria. But from a GDP basis, Benin is 5% of the size of Nigeria's economy. So you can see the kind of challenges, right? I wish we had all the answers. We don't, right? Insurers are naturally they have long investment appetites. They're very consensual. They like to partner up, so they are really good partners for the kind of people looking to do trade finance in Africa. But they're also subject to the same kind of constraints. And by the way, let's not even start talking about things like whole turnover insurance in Africa. There is literally no whole turnover insurance in pretty much the entire continent outside of maybe South Africa. So, yeah, big challenges, but opportunity as well.
A long way to go. George, do you, for your institution, see insurance as something that would help your side?
Yeah, absolutely. Both for Investec in this specific space, but I think more broadly across the market as well, because it helps with actually both problems, maybe indirectly. But if you can put all of these assets into portfolios that the insurers can get their hands around, because you're right, they have, it just falls through their fingers at the atomic level. But if you can put it into portfolios that insurers, whether they're ATI DFIs or whether they're Lloyd's syndicate, and they can wrap that, turn the bank Basel capital into Solvency II and much lower capital weightings, then you solve the capital problem, and once you've got a AA wrap on it, then you can solve the liquidity problem, because there's $50 trillion washing around the planet, and then everyone wants to invest in AA risk. So that's a good solution.
Well, it's probably kind of a macro view, but what I agree is that there is a lot of room for insurance and supranational organizations to play a bigger role. That's for sure. John, you may remember when you were with ATI, right, we tried to obtain the cover to extend some of the trade finance flow. And I'll tell you what I've seen. So it's either there is no obvious solution, or there is no simply resources to implement what's available. So there is a need, that's totally agree. And yes, if we will take the route what just George suggested, or take a slightly different approach, kind of to tackling through the maybe standard products that could be easily implemented, that would certainly contribute to the very gap we're discussing here.
Okay, I'm going to move on in a second to Shalina to look at alternative financiers. But just before we did that, I'll just ask if there are any questions in the room on what's been said so far. No? Okay. Shalina, over to you. We're obviously, even before COVID, the banks, certainly the international banks, were stepping back from this market in Africa, meaning that alternative sources of capital were becoming even more important. Where do you see the funds and the other non-bank FIs fitting into this picture? Can they make a real difference, particularly in the SME market?
Yeah, sure. Yeah, I think, Simon, you mentioned that there were already a few trends in circulation regarding the withdrawal of funding or the decline of funding to a certain segment. And I think that there definitely starts talking to the fact that banks in Africa intermediate 40% of Africa's total trade, compared to globally where it's around 80%. So I think that this has basically created a gap for alternative trade financiers to coexist alongside commercial banks. I think there was a study done in the UK not too long ago where your mid-tier and corporate clients indicated that they were considering switching to alternative lenders for their trade finance requirements. And I think that part of this reason is that alternative trade financiers and funds have gained more reach and relevance over a certain period, and that is due to their deep understanding of the value chain that they are financing. They are aware of certain risks and how to mitigate these risks in these value chains that traditional commercial banks may not necessarily be equipped to, or perhaps not have access to certain platforms. And also there's the aspect of the different capital treatment regime that they may be subjected to. So Natalia and George mentioned the aspect of insurance. And we have seen more collaboration between alternative trade financiers, commercial banks, and insurers in terms of trying to support SMEs. So perhaps maybe just a comment or question back to John to maybe just give some perspective on how he has experienced the collaboration between insurers and alternative trade financiers in regards to providing access for SMEs to trade finance and liquidity. Thanks, Simon.
Thanks. Yeah, it is something that can be explored, absolutely. Insurers are definitely willing. That, going to the ESG point that was being raised, insurers are also under pressure to deliver on that front and not just to tick boxes on it. And I think everybody knows that SMEs are really critical to development. So there's a huge willingness amongst insurers to think about this, and obviously in the multilateral space, insurers are very interested in the SME product. So ATI has a lot of focus on that, but historically, if I'm honest, had struggled to convert that focus into tangible delivery. Having said that, again, when I was at ATI, we did have a meaningful SME portfolio, so it's not like these institutions aren't doing anything. And then there's African Guarantee Fund, which again is entirely focused on SMEs. So there are some dedicated insurance solutions out there. For the private insurers, getting them to look at SMEs in Africa, it would be tricky. I think one would have to come up with a really structured solution, frankly. So probably portfolio, probably tranched, and you'd have to have the equity tranche feeling the pain and the insurance wrapping a senior kind of level. That's the sort of way that I would think about it. And I think if people can come up with those kind of solutions, that's probably the way that you could get insurers to think about it.
Does that answer your question, Shalina?
Yep, thanks.
If we could just move on now to talk a little bit more about technology and the role that digitization can play. George, you mentioned about the DFIs and what their requirements are these days when they're dealing with this market and the trade finance sector. Do you see digitization helping that process or hindering?
Yeah, absolutely. So I think there is, following on the alternative funding kind of theme, there seems to be a great deal of interest, particularly now there's this kind of ESG overlay in international investors, alternative investors, looking to invest in exactly this alongside, as a new asset class, with a great default profile, but with an African premium, where you can look at it alongside bonds, equities, commodities, cash and trade. The problem is proving that it's trade, right? And again, that's where we have an information problem. The solution to that is certainly digital. Right?
Yes, I suspect that's right. Sorry, did you want to jump in?
I just can sort of expand the subject, if it's okay. I think I totally agree with what George just said, but there are a couple of other challenges I see sort of on the ground. One is, for example, just electronic documents, right? At one level, it gives me great optimism because we know that some instruments been already fully legalized, like in Singapore and some country in the Middle East. And I think there are very serious and substantiated discussions here in the UK. And I hope we will see the breakthrough very soon. Well, the challenge is, of course, if our counterparties in Africa still need physical paper, that provides obvious limitations to what we can do.
And sorry, I guess there are two issues there. One is the information in terms of actually pinning down the buyer, the seller, the amount, the goods, etc., and to prove it's trade finance. The other is a timing issue. Basically, the banks and the actual merchants themselves need the money now, and they're only actually going to be able to put that into a portfolio and put it all together and aggregate it up through the chain to the DFIs in maybe a month's time, right? So there's a timing issue as well, which can be solved because everyone's trade portfolios are necessarily rolling and they never disappear. But it has to be clear that you're using evidence from the past in order to justify actually future receivable financing, right? And that's maybe something that the industry needs to get its head around as well.
I think this is one of many challenges when people saying, oh, the technology will be sort of resolve everything. I think another challenge is, even if we find a good technology, we need to forget that the access to it for particular small organization, even smaller banks, just never mind companies, is a challenge on its own. And one of it is, it's expensive, let's be honest. Any transition is very costly. And I think what we all would like is to pick up the right solution. And it's not obvious. What is the right solution?
And it won't spontaneously, spring out of a tier 3 bank in Africa, right? Independently. That will not happen, right? It needs to be at a much more global level from the kinds of globally responsible organisations who have the resources for that kind of investment and development.
Well, you look at me, I was just saying, again, I don't know how we will come up to it, but yeah, maybe driven by global organization, maybe driven by influence and sort of, driven by influence from professional associations, for example. But I think some industry-wide accepted technology would be great help. I think currently we see various trial and fairs. The banks with the deeper pockets can develop their own products. They're trying to see what they can buy off shelves, or etc. We're not yet there. Absolutely.
I agree. From my own perspective, I would throw in the legal issues as well, because you've got two things here which move at very different speeds. Technology is lightning quick. Changing the law to catch up with it is very, very slow. And you've got to be able to do that across the board in each of the countries where it's going to be used, and that's going to take a long time, I think, without wanting to be too doom and gloom. But it's just another issue on the table. I want to move on now to the last bit of this session, which is really looking at that a bit closer and looking at what governments, regulators can do to help. There are clearly lots of issues around that at the moment. And George, perhaps if I can come to you to really look at that side of it and see how you feel that the regulatory position could be changed, or governments can do other things to help close the gap and make life easier for those trying to get finance into the market.
Well, yeah, so necessarily we are regulated, particularly the banks who offer this kind of trade credit are necessarily regulated, and we have to follow global standards. But the way that we follow those standards is not necessarily completely consistent across the board. There are a lot of banks in Africa who are still on Basel 1 point something or other. And local regulators can adjust and attenuate the way that they insist that their financial institutions actually implement the global standards and the global rules. And there's a good case for both global as well as local, regulatory forgiveness or some kind of safe harbors or some kind of attenuation of the implementation of the more toxic, inappropriate regulation associated with this particular problem. particularly as it comes to sort of Basel 3.5, 4. As I understand it, there was a good deal of lobbying with Basel, but Basel just simply turned around and said that they weren't interested in trade finance. That's not their business. They're here to protect the global economy. That's not the case for local regulators and for local governments. And the hope would be that there could be some kind of support rather than people on the global stage, wringing their hands about the state of African development and the trade gap. They could do some practical things, particularly in this particular direction.
Yeah, I just want to pick up on one question that's come through, which sort of links both the technology part and this. And the question is, and it's open to whoever wants to respond, how the banks can engage with governments to increase the use of digitization and alleviate some of these issues, regulatory or otherwise. Anybody have any views?
I mean, I can say that trying to engage with African governments is not easy, because I've had to do that quite a lot, whether it's trying to resolve defaulted debts or whatever. You spend a lot of time waiting in the office of the Minister of Finance, etc. So trying to get government engagement on very technical matters, as we're talking about, like George is talking about, is incredibly difficult, unfortunately. Again, one of the things we were doing at ATI was trying to get some of the member governments to recognise that insurance should allow capital relief. But that literally involved, and to your point, George, going and knocking on the doors of the Ministry of Finance and the DRC and explaining what these products were and why they should end up giving capital relief to their banks using insurance. So it can be done, but it's very time-consuming.
Yeah, I mean, my personal view, and coming from my experience, is that actually dealing with the governments, both on a global, but particularly in Africa, and even their central banks, is that kind of misses the point about where the technical strength is, right? The technical strength is actually in the private commercial banking world. That's where standardization needs to be a kind of agreed. Frankly, even central bankers don't really understand the nuts and bolts of trade finance, even within their own jurisdictions. So that's probably, you probably want their support politically, but the solution isn't going to come from them. Shadow ledger technology that's needed at that level probably needs to come from the banking industry themselves.
In my view, the technological development should be privately led as well. I agree with what Guy said. I don't think we will have issues with government, but I don't think we should naively sit and wait for them to cooperate or give us the solution. I think that will never happen. How private institutions can organize themselves, it's a different matter. So we have various lobbying platforms. We know that we have various strong associations. Simon, I don't need to tell you about ITFA, for example, who I don't think we have any recent conference or serious sessions without talking about technology. I think that that's probably the path. I think otherwise it would be just a naive position to think that it's sort of cooperation that's waiting to happen.
Okay.